Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Jacob, thank you for taking some time to join me on the show.
Owen, it's great to be here.
Great to be back. It's been a long time.
It's been too long.
But we've been following along with the Antipodes story ever since. And even before that, I remember that first conversation we had, I was already familiar with the brand that you had built and the team you've kind of put together around you. And it's great to see everyone's mostly still together and the business is going well. So we'll get you to reflect on that in just a moment. But some icebreakers to start, mate. First of all, two questions. One is, what was the most recent, or what is the most recent company that you invested in? You could say, you don't have to just say company, it could be anything.
Yeah, look, obviously, a lot of my, personal investments are in the Antipodes funds. But outside of that, look, I've held some, I hate to admit it, but I've held some gold stocks for quite a long period of time.
Yep.
Haven't been great investments. But look, I think, it's probably, from my perspective, I've seen it as a little bit of an insurance policy, given how much exposure I have to equities in the Antipodes funds and via the business. And I think the longer I hold them, the closer they probably are to, working, in the sense that, we may at some point get some sort of systemic event where, the Fed has to reverse its QE policy. And the stocks are arguably quite cheap on sort of measures of earnings power.
Interesting.
Yeah.
I like that. It's an answer that I didn't expect you to bring to the table because, but it makes sense because I'm assuming so much of your exposure, personal exposure, the business, the funds, it's all, in the stock market, it's in businesses. And so, you, like anyone, would be mindful of that and aware of that. The second question is, so if that was the recent exposure or current exposure, let's go back. What was the first investment you made? If you can remember the company, if not, it doesn't matter. But what was that first investment?
Yeah, well, continuing the sort of resources theme, once again, a little bit embarrassing, a mid-cap mining Australian exploration stock. And very early on in my early 20s, invested on the back of a newspaper article. This is prior to me getting a job at Tyndall as a trainee investment analyst. So I really didn't know what I was doing, but it worked out. It was a stock that ended up being taken over, and is often the case in resources. And look, it worked. Probably not one I would put in the worked as, because there was a well thought out investment case.
More luck than skill, let's say. But you got to start somewhere, and it worked out well. So that's probably the key takeaway for me. And it probably helped set you on this journey that inevitably led you here. The third icebreaker that I've got for you is, what tool, resource, or information do you use as someone who has a global perspective, runs a very successful funds management business? You sit back and you spend a lot of time reviewing, using whatever, because a lot of people that listen to this are private investors, individual investors, and they're sitting across the table. They'll spend a lot of time at brokerage accounts or sifting through annual reports. What do you do from your view? What are you looking at each day?
Yeah, it's a good question. I mean, that investing toolkit is constantly evolving and, broadening. Clearly, I use a lot of Antipodes research.
Yep.
And then our toolkit at Antipodes is, over time, we've built out. Obviously, we use a lot of fundamental data, and we have a lot of templates that we use to pull that data out of sources like FactSet. We also use a lot of macro data and increasingly also alternative data, and to track how investment cases are evolving, relative to our expectations. So I said data a lot.
Yeah, you did. But it's important, right? Because you have that global perspective. There's a lot of companies in the world. There are a lot of data points from different countries, from different parts of the world. I remember back when we first talked, it was a few years into the Antipodes journey, but more have passed. And, the business has multiple investment strategies. The team members, I think, now number over 30. And the brand is well established in Australia and globally. So I wanted to just ask you to take a moment just to reflect on that journey. Maybe for folks who haven't come across the Antipodes brand, maybe you could just tell us kind of where it started and where we are now.
Yeah, look, we invest with a pragmatic value approach, which really simply put is paying the right multiple relative to the underlying growth of the business, whether that's high structural growth or lower, more cyclical growth, and relative to the package it's coming in, like the business resilience. So there can be a continuum of growth and resilience, and it's paying the right multiple along that continuum, which I think is very different to conventional value, which is really says low multiple is just intrinsically good, irrespective of the underlying business quality or growth, or growth investing, which puts a lot of emphasis just on growth, irrespective of multiple. So we are valuation-driven investors. Probably in some ways maybe too valuable. Look, it's very difficult when you get markets that are driven by momentum or by a particular sort of, let's call it, bias. But I think the team that philosophy is, I think, through time proven to be a very good one from a combination of return versus risk. Because you do get drawdowns in certain, crowdedness can often unwind in a fairly ugly manner. Look, we also really emphasize industry research, leading with industry research, in iterating towards the investment case, but from the perspective of understanding how the industry is going to evolve over time and what are the drivers of competitive advantage in that industry, because industries are quite different one from another, and that allows you to cover the market in a fairly efficient manner. 30 in the investment team, but the global universe of companies in ACWI, you've got to be across over 3,000 companies. But if you break that down to, let's call it 50 or so key industries, then it's manageable.
Yeah. And I remember when we first spoke, we spoke a little bit about the idea of I think it was clustered research and having analysts work in clusters. Can you just elaborate on that a bit? Because I thought that was really interesting in the way you bring that together.
That's really just an outworking of that approach. Often we find, an industry the market will be concerned about maybe a longer term, a change that's happening to that specific industry. It could be something happening in the macro that is negative for that, which ends up being a cyclical phenomenon. But it does give you an opportunity to invest, at an attractive valuation. So you will find more than one opportunity, and often as a result of that approach. And you may also find different opportunities up and down the market cap spectrum. And as long as we think there's a minimum level of business resilience, minimum number of ways we can win in the investment case, we can build a cluster of opportunity in the portfolio around that industry research.
So effectively, and I feel like this optimizes analyst time and analyst mind share, and you can effectively task those analysts with, this is the cluster where we are looking at now, build that core competency. Because let's say, for example, you're looking at, there's really obvious examples, and I'm sure we'll come back to this, but say you look at Google and it's an internet-based search business, and then you think, well, what else is in that ecosystem? Well, maybe there's Meta or something else. They're kind of clustered together. They're joined in some ways. They're different, but you're building a body of knowledge on search and Google search here. And at the same time, well, that might be relevant because that might be shifting towards Amazon with Amazon's ability to bypass search altogether. So it makes sense that the analyst teams are building that intellectual IP, like that intellectual property that they're building on that specific industry to then see, well, what else is in the market?
Absolutely. So it starts at a high level. It would start as advertising. These are companies that participate in the ad market. How, what's happening in the ad market. Then it would come down to digital advertising, and that's dominated by two companies in the Western world, and Meta and Google. And then, then it comes down to, there's a tail of smaller companies, and Amazon, as you point out, is growing quite quickly in advertising, digital advertising on its e-commerce platform. So bringing all that trend using, independent data providers to give us insights on how those market shares are shifting, speaking to industry experts to understand what trends are going to drive those future shifts. And then, bringing it down ultimately to a company model for each of the key companies, and then trying to work out that, the hard part, which ones are mispriced, and is the market actually getting anything wrong?
Yeah. This is a good segue. We might go there now. We were talking off air about how a lot of people, let's say in the last 3 to 5 years, maybe even a bit longer, talking about these companies. We just mentioned 3 of them: Amazon, Google / Alphabet, and Meta. And we could expand that to Apple and maybe before that Netflix and these types of businesses. And those companies are capturing not only a significant amount of investment dollars, but they're just pervading, it seems like, the investor zeitgeist, if you will. Like, everyone talks about them. We're talking about them right now. But as you rightly pointed out before, even if you are refining your global universe, there are still thousands of companies in your universe, right? You've got companies all over. So I'm curious how you think about basically like the narrowness of, you could take that as like the US market, you could take it as the global marketplace, how you think about that, because Aussie investors are pretty familiar with a top-heavy market, but these are multi-trillion-dollar companies in terms of market cap now. So I'm curious how you're thinking about that with a global lens.
Yeah, look, there's a couple of different characteristics in that group which the market is celebrating, and market cap concentration, market narrowness. They're both close to record levels in terms of what's working, and also in terms of market cap, and in terms of profits. That's how concentrated profits are in the US, but it's also a global trend. You just can't find. You almost have to go back to you're almost going back 70 or 80 years to find a level of concentratedness in profits. So typically following that, you've had periods of antitrust behavior to break that down. Now, we're not really seeing that today.
Yeah.
But things can change, and I think we would say it's almost like a bubble in quality growth with an AI tech flavor, but not everything. Like, it's interesting, just in the US, a company like Costco, not growing that fast on a PE 50. You can buy even Walmart, not growing that fast, a PE of 28.
Yeah, well,
you can buy, Tesco in the UK on 12. Go to emerging markets, you can buy something very high growth like Sendas, which is a cash and carry, dominant retailer in Brazil in grocery, on a PE of 13 and probably growing at about 30%.
Wow.
Per annum. So it tends to be a US phenomenon. It tends to be profitable companies. And look, if there's an AI angle, then, definitely it's supercharged.
Yeah.
We're hesitant just to say that all those companies are are overvalued. I mean, like the growth that you're getting in a company like, Amazon's actually arguably the one that's on the most attractive relative to its own history. Probably the one that has the less AI risk in it, because I think there is a reversal opportunity coming. Like I think people have got a little bit carried away about how quickly AI will be adopted, how easy it is to monetize use cases. Meta's probably done the best job because it has a fantastic opportunity in its core ad business to use AI to target ads. Microsoft's doing it through Office 365 and selling as Copilot, but quite frankly, you're paying a pretty punchy multiple now for Microsoft. So we think Oracle, we've got a bigger weight in Oracle. So I think you've got to be selective in that group. That growth has been good. So they've earned their multiple. Whereas I think in things like Costco, I sort of struggle. I think, well, have you really earned that multiple? Like if your multiple's doubled over the past 10 years, but your growth rate hasn't.
Yeah, it's almost as if I'm a fan of shopping at Costco. I don't own shares, but I like the experience of going there. And I feel like that probably lends itself in some roundabout way to people paying more for the shares. Maybe not, but that is quite interesting. I did notice in the latest update that Amazon was a position at Antipodes. So I did see that, and I thought to myself, that's quite interesting, given the conversation we were going to have. One of the things that I was keen to ask you about is, so obviously there's these companies, NASDAQ listed, big tech US, but there's so many opportunities outside of that. I think one of the things that some people struggle with is if you do take a global perspective and you look abroad to say, so we compare the US to say Europe, and then you look at say Asia generally speaking, or emerging markets broadly speaking, people often, they're a bit like, oh, I'm not as familiar with that. Americanism, I'm pretty familiar with that culture being from the Western world. But they may also think that there is a different culture with those respective markets and their, I don't know, let's say government authority in terms of like, say the Chinese market, people get worried about that. Or in Europe, I just come back from a holiday, love the food, love I think siestas in Greece are necessary. It's so hot, but like we're familiar with like US capitalism, stock market being a primary, it's like an artery that flows through that economy in that country.
Yeah.
But then how do you think about that cultural difference and how that plays out in long-term returns? I know that's a really fluffy question to ask, but you have the global perspective, so I'm curious.
Yeah, look, I'll answer that question. I just wanted to just to add something on Amazon, just as an example, illustrate how we go about our approach to valuation. So the analyst and the sector team will essentially model out on a DCF basis. Now, the important thing though is we then contextualize that answer. There's always the risk with any DCF, garbage in, garbage out.
Yep.
Test the assumptions, but also test the valuation. How does that valuation look implied on a multiple basis versus the history? And we do that by calculating the implied forward relative multiple on PE earnings basis. We may do it on an EBITDA basis. We even use sales also just to see, because margins may be above trend or below trend. So we do that on a relative basis to the market on a forward looking. And then we also test that against how that relative multiple looks versus that company's average. So are we implying a big re-rate versus how the company's been priced in the long term? And Amazon in the Mag 7 is the only stock that actually screens well on that basis, where its PE multiple and its revenue multiple, so at both ends of the P&L, is below the longer term trend.
Interesting.
Some of them are, Alphabet is also below its longer term PE multiple, but it's more profitable than it has been. So it's actually still punching a higher revenue multiple.
Whereas Amazon may have that latent.
Yeah. Amazon goes through these long investment cycles and it's coming out of that. It's about, let's call it typically they're 5-year type, 6-year type investment cycles. And it's really only 2 years into optimizing and harvesting the benefits of the last one, which was really around growing out the AWS footprint and investing in same day delivery capability in the US and building that on platform advertising capability for its third party sellers.
That's really caught me by surprise, the 3PL and the power of that. But it makes so much sense. And seeing some of those, even some like national posts, for example, instead of saying you can send it through the Australia Post network, you can send it through Amazon. But Australia Post just happens to slap a label on the way through or something like this. And I think that just speaks to the sheer competitive advantage and power of that business. And we're really talking e-commerce. Then there's all the other things that they do, right?
Yeah.
And I just think that, like you said, that's something that's been playing out for probably decades now.
Yeah.
Which is just incredible.
Yeah, it's a very strong company. I mean, I think 3-4 years ago, they really put a lot of effort in just getting their DCs closer to the population in the US, so they could basically disintermediate UPS and FedEx, and build a lower cost delivery platform that's focused on local delivery as opposed to interstate delivery.
And that's not easy to build. That's incredible.
Nah. Which is why profitability went down a lot.
Yeah, exactly. Yeah, to your point. Yeah. And so now if we switch to that global perspective about the differences between Europe, America and Asia, or however you bucket that, how do you think about those marketplaces from a long-term perspective?
Well, yeah, like as you highlight, Europe's a great lifestyle destination in summer, and in winter. The America has lots of productivity enhancers, 2 weeks of annual leave,
which shocks most Australians, by the way.
Effectively hiring and firing at will. An economy which has been arguably more encouraging of investment, whether it's through generally through a fairly loose fiscal policy since 2018, with the Trump corporate tax cuts. You've actually, you've turned the US into an investment driven economy, which is at the same time that the household was given a lot of handouts in COVID. And so you've had a supercharged consumer and a supercharged investment cycle. So I think we've got to be careful. We've got to separate what's been driven by policy that ultimately has to prove to be sustainable. And then arguably fiscal policy isn't in its current form. And what's actually driven by a difference in, cultural. And look, there's definitely more. The US was more optimistic, I think, as a society, but the statistics tell us now that that's changing. It's much more polarized. We all know that from the political discourse. But also, average age is declining in the US for the first time, and it's declining relative to other equivalent wealthy economies. So that's sort of quite concerning from a public policy perspective.
I did not know that. That's fascinating.
Yeah. Now that may change depending on what GLP-1s do, and whether they're actually good for your long-term health.
Yep.
But look, it's clearly Europe. Question in Europe is really not so much. We think at longer term, the ECB will be the key policymaker in Europe. National governments will all try and optimize for their local issues. And the ECB is the one European institution that can try and bring that all together.
Bring them all together, yeah.
Yeah, so there may be let's call it more of a more risk to a longer term stagflation scenario, maybe in Europe versus say the US, which should have, I think, higher growth. Now, you got to be careful to then extrapolate that to European equities and say European equities are fundamentally low growth. I mean, if you're owning a multinational in Europe, you're not locked into that European growth outcome.
Yeah, I remember standing in Amsterdam about a month ago, maybe 6 weeks ago, and standing outside the Adyen building. And there's been a lot of talk about that globally.
Yeah.
But I just saw it was just a buzz. And there are numerous examples throughout Europe where you look at that business and you're like, that is a global business. It just happens to be headquartered here. Yeah. And I was surprised, like naturally being an investor, like every country that we went to, I'd be like, what's on the stock exchange here? And it's fascinating to see some of those businesses that stand head and shoulders in the global marketplace. And if you only have that US lens, you forget, you don't take into account that they might be a global business, just happen to be listed somewhere else.
Well, look at Airbus. I mean, it's, yes, it's like the entire aerospace sector is having supply chain issues, scaling, its production, it's fundamentally taken market share from Boeing. And, that we would argue that's a somewhat permanent shift. And, it's got this stellar order book and its production rates are running at really half of where they should be. And, so your earnings you've got a lot of protection in current earnings. Yeah, earnings can grow in a steady state economic environment. And, it's really interesting value. And it's a great example of what you can find in Europe.
How about that if we turn our gaze across to say, and this could be Asia generally, emerging markets, but say, for example, if we just looked at China as an example, people have seen kind of like a dichotomy, like up until, say, a few years ago, everyone's talking about Asia, China. And we saw companies like Alibaba taking on, global marketplaces, these types of things. With a long-term perspective, the economic engine, and I know you kind of referenced before that not necessarily the economy is not the stock market and vice versa, but with an economic lens, it is an engine that is ferocious, it's growing. How do you think about that culture, that regulatory regime that we're in for long-term investors, for investors who are looking to create wealth from equities?
Yeah, look, China's always had a vibrant private sector. I mean, otherwise it wouldn't be the economic powerhouse it is today. The tragedy is that that's come with a Chinese Communist Party wrapper, and that under Xi, that there's been a shift, it's had economic impact in the sense that they've been willing to push reform, but what really is a resizing of the property sector in a very aggressive manner, and that's impacted the household sector. I think there is a natural reflexivity in that policy, as in eventually you have to, if you push it too far, you'll endanger the patient. And look, I think you're close to that inflection point where policy becomes much more focused on growth and the household sector growing. If you don't have, China already had excess savings and now it has extreme excess savings. Versus say the US, which is, excess savings now below trend. Savings are below trend. China's significantly above trend. And there will be a limit to how far they can push exports. They have an incredibly competitive, even with tariffs, given the scale of the private sector companies that are exporting and their, entrepreneurial flexibility and, moving. A lot of the offshoring is being done by Chinese companies. They're going to Vietnam, they're going to India, they're going to Mexico to access, those domestic markets, but also access the developed markets where they've even if they haven't been hit by tariffs, they're actually de-risking their own supply chains. So look, that scale means they are still taking share in exports, even with pretty aggressive tariffing. And almost 50% of their exports are going to non-developed markets, right? So, and we forget about the other 7 billion people, right? And
yeah, it's fair to say.
And their products are quite attractive because they're high quality, low cost to that cohort in EM.
How about Antipodes? So in terms of the way you've positioned the portfolios, obviously you've got multiple funds that do certain things and people can go to the website and look at the different strategies on offer and see what kind of exposure they want. Obviously there's the global fund and which most people are familiar with. But how about as a business, in those strategies, however you want to take this, how do you think about the opportunities and where are you positioned for that?
Yeah, like today we certainly are looking for, just pragmatic value opportunities in that we do think the market will ultimately, the winners will broaden out. Now, the question is, in what form does the economy evolve? Are we seeing, can we would say 50-50 between the soft landing globally versus something that's a little bit less smooth. And the less smooth scenario is, rates having to stay, inflation just being a little bit stickier than the Fed thinks, and rates staying higher for longer to the point where something breaks. And, probably the obvious, the elephant in the room would just be the rapid growth in fairly junky corporate credit. The US version of private credit is very different to our local version, right? I mean, the leverage ratios are double. It really is junk. And that's been a asset class that's been compounding in size at around 16% per annum. So that's where we think the key, and clearly that's been a big part of supporting private equity through a very difficult realization cycle. So we think that pressure just sort of builds up if you don't get lower rates. So we're very mindful of that. And that's, I think, driven some of the concentration in the US equity market. Investors are very concerned about they're crowding into quality because they're concerned about, credit issues in lower quality companies. And they're also concerned about AI disruption. How does this impact, companies that are smaller? Now, where to from now? I think, we will start to think more about who are the second and third order beneficiaries of AI. It's not all the benefits are going to accrue to Microsoft and NVIDIA. We've got some great opportunities. We have a cluster of opportunity stocks that are built around that from Oracle. But there are other opportunities in that area. Oracle's probably the largest exposure we have in that specifically. We think on the hardware side, TSMC, right? Like all roads lead to TSMC. It's still, we think, a reasonably attractive valuation. Energy transition. That's all roads, whether it's the need to decarbonize, it's the need to support ongoing adoption of data centers that are supporting AI, even Bitcoin, they all lead to greater need for electricity as a generation and source, and ultimately green power and a grid that needs to be reconfigured. And you look at China, I mean, China deployed 325 gigawatts of renewables, wind and solar, roughly last year. That's the equivalent of a 10% growth in their entire generation base, more than 10%. So these are big numbers, right? So China is arguably all of its incremental. 1 year of growth in power demand in China is equivalent to almost a Japan or 1.5 Germany's in terms of new power demand. All of that is coming from renewable sources. Now you think about what the West is doing and needs to do. So that, you can obviously play that cycle in China. Right? That's the interesting, people think, China's going to be low growth. Demographics are terrible. Yes. Reminds me of another country that, in 10 years ago, everyone thought was uninvestable. Japan. And lo and behold, there's lots of opportunities in companies that have structural tailwinds. So that's in that area.
Now everyone talks about Japan.
Yeah, now it's flavor of the month, which is very frustrating for an old Japan portfolio manager. But there's definitely, I think there are parallels. Like if you think about where the narrative is around China versus the narrative around Japan, and how perception can change, and what, identifying that catalyst in regards to China, it could simply be valuation. People sometimes forget that the valuation alone can be the catalyst. Our exposure to European banks, it worked because those banks actually just started doing aggressive buybacks, which realized, which catalyzed the valuation argument. Bringing it back to the portfolio, we do think you can build in structural tailwinds in companies that are still quite cheap in energy transition. Siemens Energy is a good example. There are many others. We have specific plays on that in grid investment exposed companies, also in China. In companies that are lower growth and classic candidates for that broadening out, if you get the softer landing, there are banks. I think Capital One Financial in the US is a good example of a bank that's been hit by high rates. Investors will become less worried about it in a rate cutting cycle, and it takes pressure off its customers. It's a credit card. It's credit card customers. But then in the emerging markets, Brazil's got policy rate of around 12%. I mean, how does anyone survive?
Yeah.
With 12% interest rates at the short end. And we do think a lot of the concerns around fiscal sustainability are sort of somewhat misplaced. I mean, all that Brazil has said is that they're going to delay, they've got a 70 basis point primary deficit. 70 basis point. It's low, it's small, right? Now the fiscal deficit's bigger than that because their cost of financing, think about a 12% policy rate. So it's supercharged to lower rates. And look, they are committed to getting back to a primary surplus. And look, I think that's all you need in the next few years, given the backdrop of where the US is. I mean, if we're not exactly living in a world where developed economies and countries are running responsible fiscal policy. So I'm not sure why we have to be so hard on Brazil.
Yeah.
And so it's a big beneficiary of the softer landing, lower, inflation coming down fast enough for the Fed and for other EM central banks, whether it's Brazil, Indonesia, or quite frankly, it just takes less, it gives the Chinese more policy flexibility as well. Yeah. The one country that doesn't really benefit from that, we would argue, is the one that's really expensive, India.
It's hearing you talk and hearing you go over these things today is reminding me of again and again of the importance of being really mindful, especially you add that it's not like even being mindful in the US, like what's your concentration? Where are you exposed? What parts of the market cap? Which industries? What geographies? But more so when we look abroad, which is kind of a lot of Australian investors I find take this approach of they're often quite one-dimensional, and then that's the US focus, and then everything else is just everything else that kind of gets lumped in. But I think that's something that I hold dear is that when we look at these other markets, sure, there's those kind of cliches about I made them before about Europe or China or Asia generally or whatever. And you mentioned Brazil, but it's about being selective in those marketplaces. It's about having done the research, understanding what you're getting for every dollar that you allocate. As an individual investor, as a professional, just treat it the same. I will direct people to the Antipodes website, antipodes.com, where there is a lot of literature that you guys put out, a lot of research that you put out, and it's freely available and people can subscribe and those types of things. But there is also the listed fund, which I'll call out. I'll say the full name because I know the ASX rules have got a bit tighter on these things lately, but the Antipodes Global Shares Quoted Managed Fund, and the ticker symbol is AGX1. So it's available on or in your brokerage account, and you can refer to the website for more information, but also just find out, have a look at the portfolio, see what's in there, hear from Jacob and the team. Jacob, this has been a lot of fun. So I do really appreciate you taking the time to come across town to chat with me here in Sydney. It's always a delight to speak to you. And until next time, mate, I wish you all the best with Antipodes and appreciate it.
Excellent. Thanks, Owen. Great to be here.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.